For the next 45 minutes, I challenge you to question everything you've been taught about money. The conventional wisdom that says save 10%, focus on your career, and invest conservatively might be the very thing keeping you from financial freedom. In this documentary, I'm sharing my journey from financial struggle to abundance, including the exact income experiments that now generate over $10,000 monthly outside my day job. You'll see the real numbers, the psychological barriers I had to overcome, and the specific strategies that created results when traditional advice failed. Are you ready to break some rules? The financial prison I built for myself. Ever wonder if your own beliefs about money are the invisible chains holding you back? That was me 3 years ago. I was living what looked like a responsible financial life on the surface. I had a steady job, paid my bills on time, and even managed to save a little each month. But underneath that facade of financial responsibility, I was drowning. Let me paint you a picture of my financial reality back then. My salary was stuck at $45,000. Not terrible, but definitely not enough to build the life I wanted in a city where the cost of living kept climbing. Each month, I diligently transfer 8% of my paycheck to savings, feeling proud of myself for that small act of financial discipline. But that pride quickly evaporated when I'd look at the other side of my financial ledger. $22,000 in credit card debt that seemed to grow no matter how carefully I tried to manage my spending. The worst part, I was following all the right advice. Every personal finance book, every money guru, every well-meaning relative, they all had the same basic playbook. Save at least 10% of your income. I was close. Focus on climbing the corporate ladder. Avoid risky investments. Pay down debt slowly but surely. I was checking almost all these boxes, yet my financial situation wasn't improving. If anything, it was slowly getting worse. The psychological toll was crushing in ways I hadn't expected. I developed a weird ritual where I'd only check my bank accounts on Friday afternoons, because if the numbers were depressing, and they usually were, at least I had the weekend to recover emotionally before facing another work week. I'd feel my heart race every time I had to use my credit card, knowing I was digging the hole deeper. Worst of all was the shame. I had a college degree, a professional job, and worked hard. Wasn't that supposed to be enough? My friends would invite me out for dinner, and I'd make up excuses. I'm not feeling well was easier to say than I can't afford it. When my car needed repairs, I'd feel physically sick with anxiety. I once drove for 3 months with the check engine light on because I was too scared to face whatever financial hit might be coming. That's no way to live. The real kicker was that I was so convinced I was doing things right. I'd set up my automatic 8% savings transfer and felt virtuous about it, even though I was simultaneously racking up credit card debt at 19% interest. I declined opportunities to invest in a friend's startup because it seemed too risky, even though my safe investments were barely keeping pace with inflation. I turned down freelance opportunities because I was told to focus on my primary career path, despite the fact that my salary increases were barely covering the rising cost of living. I remember the exact moment everything changed. I was sitting at my kitchen table on a Sunday morning, spreadsheets open on my laptop, trying to figure out, for the 100th time, how to make the numbers work. I just received a generous 3% raise after killing myself at work all year, and after taxes, it added about $80 to my monthly take-home pay. I realized that at this rate, I'd be paying off my credit cards for another 7 years. 7 years of financial stress, 7 years of saying no to experiences, 7 years of pretending everything was fine. That's when it hit me. What if the financial rules I'd been following were actually the problem? What if the conventional wisdom about money, the very advice that was supposed to help me build wealth, was actually creating my financial ceiling? I started questioning everything. Why save exactly 10% when my debt was costing me double that in interest? Why focus exclusively on my salary when there were countless ways to make money in the digital economy? Why avoid risky investments when my safe approach was guaranteed to keep me treading water? The financial rules I'd been following weren't designed to make me wealthy. They were designed to make me adequately poor. Comfortable enough to avoid desperation, but never comfortable enough to achieve true financial freedom. These rules were creating an invisible prison around me, and I had been my own jailer, diligently locking myself in each day by following this responsible advice. Here's what I realized were the most damaging financial rules I'd been following. 1. Save 10% of your income no matter what. even when I had high-interest debt that was costing me far more than my savings were earning too. Focus on your job as your primary income source. Ignoring the limitless possibilities for side income that could have dwarfed my salary increases 3. Pay down debt slowly and steadily, which meant years of interest payments that were keeping me financially trapped. 4. Avoid financial risk at all costs, which guaranteed mediocre returns and prevented financial growth. 5. Budget by cutting small expenses. Focusing on saving pennies by giving up coffee instead of finding ways to earn dollars. These weren't just financial rules. They had become beliefs embedded in my psyche. I truly thought I was being financially responsible by following them, which made the reality of my situation even more painful. I was doing everything right, yet still struggling. It made me feel like a failure, when in reality, the system I was following was failing me. What's truly scary is how these traditional money rules are drilled into us from such a young age. We're taught to be good financial citizens, work hard, save a little, avoid debt, though that ship had sailed for me, and trust the experts. But whose interests do these rules actually serve? Not mine, as it turned out. They were keeping me in a perpetual state of financial mediocrity. Not poor enough to rebel, but never wealthy enough to truly be free. The breaking point came when I calculated how long it would take me to reach basic financial goals like paying off my debt, saving a proper emergency fund, and maybe someday buying a home. Following the conventional path, I was looking at decades of financial struggle, all while doing what I was supposed to do. I realized then that I had 2 choices. I could keep following these rules and guarantee myself a future of financial stress, or I could start questioning everything I thought I knew about money and forge my own path. This wasn't about being financially irresponsible. It was about being financially innovative. About recognizing that the traditional rules of money might work for some people in some circumstances, but they weren't working for me. The money beliefs that cost me $50,000 plus. Those financial rules weren't working for me because they were built on something deeper. Unconscious money scripts I didn't even know I had. What if I told you that one hidden belief about money was costing you thousands every single year without you even realizing it? That's exactly what I discovered about myself, and the financial impact was staggering. Beneath all those financial rules I'd been blindly following lay something much more powerful, what financial psychologists call money scripts. These are unconscious beliefs about money that form during childhood and silently drive our financial behaviors for decades. I had no idea these invisible scripts were running in the background of my financial life until I started digging deeper. My journey took an unexpected turn when I stumbled across Dr. Brad Clontze's work on financial psychology. According to Dr. Klontz, these negative beliefs about money often lead to self-sabotaging behaviors, like avoiding investments or overspending, that ultimately keep us financially stuck. Reading his research was like someone had written a psychological profile specifically about me. So I decided to create my own money script inventory, a brutally honest assessment of the beliefs I had about wealth and success. I filled pages with statements that had been running through my subconscious. Rich people are greedy. Money changes people for the worse. You can't be spiritual and wealthy. Financial success requires sacrificing what matters. Some of these beliefs were passed down from my parents, others I picked up from teachers, and some seemed to come from nowhere I could identify. But one money script stood out above all others. The belief that truly devastated my financial potential. Money requires sacrifice and struggle. Wealth only comes through hard work in a traditional job. This single belief was the invisible ceiling I'd built above myself. It wasn't just a thought, it manifested in very specific behaviors. I reflexively dismissed side hustle opportunities because real money comes from climbing the corporate ladder. I ignored friends' invitations to join investment groups because passive income wasn't reliable. I even turned down a partnership in a friend's successful e-commerce business because it wasn't a serious career move. The most painful part? I could actually calculate what this belief had cost me. When my former roommate started a dropshipping business that now generates $8,000 monthly, I declined his offer to join as a partner because it wasn't a real job. That's $48,000 in annual income one walked away from. When another friend launched a content creation agency and needed a partner with my exact skills, I declined because it seemed too risky compared to my stable job. His partner now earns over $12,000 monthly. And then there was the real estate investment opportunity one passed on. a small multifamily property that has appreciated $67,000 in just 2 years, with monthly rental income one can't even bear to calculate. Adding up just these 3 opportunities one declined, that single money script cost me well over $50,000 in potential annual income, and that's being conservative. The opportunity cost compounds every year. I remain stuck in this belief system. My financial tracking from this period tells the whole sad story. While I was religiously adding small amounts to my savings, my income remained practically flat. My investment returns were minimal because I kept everything in safe accounts with returns that barely outpaced inflation. The opportunity cost of playing it safe was enormous, but the psychological impact was even worse than the financial one. Each time I declined an opportunity, I reinforced my limiting belief. It created a vicious cycle. My belief about real jobs and responsible money management kept me from pursuing opportunities, which kept my income stagnant, which proved that money was scarce and difficult to earn, which further reinforced my original belief. I was literally trapped in a psychological prison of my own making. And the most frustrating part, I had built these walls myself, brick by brick, thought by thought, decision by decision. The most damaging aspect of these money scripts is that they operate beneath our conscious awareness. They feel like objective truth rather than subjective beliefs. When I thought, that side hustle isn't a responsible way to build wealth, it didn't feel like an opinion, it felt like stating an obvious fact. That's what makes these beliefs so difficult to identify and challenge. These money scripts don't just influence our financial decisions, they create our entire financial reality. My belief that wealth only comes through sacrifice in a traditional job didn't just make me avoid entrepreneurial opportunities. It affected how I negotiated salary, barely at all, because I should be grateful for steady employment. It determined how I spent my free time, never investing it in learning new skills that could generate income. It even shaped my social circle, avoiding unrealistic dreamers who pursued unconventional paths to wealth. Every aspect of my financial life was filtered through this distorted lens. And the results spoke for themselves: limited income, minimal investment growth, and a pervasive feeling of scarcity despite working incredibly hard. The worst part was that these beliefs created a self-fulfilling prophecy. Because I believed wealth required sacrifice and struggle in a traditional job, I experienced exactly that. My income grew slowly, I felt constantly stressed about money, and financial freedom seemed impossibly distant. All of which confirmed my original belief that money is difficult to acquire. It was the perfect trap. Breaking free from these money scripts required something more than just changing my external behaviors. I needed to recognize and challenge the underlying beliefs that were driving those behaviors. It wasn't enough to start a side hustle if I still fundamentally believed it wasn't a legitimate path to wealth. The internal work had to come first. This realization was both devastating and liberating. Devastating because I had to face the enormous cost of my limiting beliefs. Opportunities missed, income foregone, and years spent struggling unnecessarily. But liberating because I finally understood that my financial reality wasn't fixed. It wasn't determined by the economy, my education, or my background. It was shaped primarily by beliefs I could change. That's when I realized I needed to transition from a scarcity mindset to an abundance mindset. Rather than seeing money as something to struggle for, I needed to recognize opportunities and take calculated risks. This shift wouldn't happen overnight, but acknowledging these limiting beliefs was the crucial first step. The decision to break the rules. Recognizing my limiting beliefs was just the beginning. The real question was whether I had the courage to actually defy conventional wisdom. After acknowledging those unconscious money scripts, I faced a critical choice. Continue following the financial rules keeping me stuck, or deliberately challenge every single one of them. My research into self-made millionaires had revealed something shocking. The people achieving extraordinary wealth weren't following the conventional advice at all. They were systematically breaking the rules in ways nobody had ever taught me. I still remember the exact moment I decided to rebel against traditional financial wisdom. It was a Tuesday night, and I was staring at my financial spreadsheet for the 100th time. Despite doing everything right according to the experts, my finances were barely improving. That's when I asked myself a question that changed everything. What if the rules designed to help most people achieve modest financial stability are actually preventing exceptional financial growth? This question hit me like a lightning bolt. I couldn't shake it. So I started researching self-made millionaires, not the inheritance crowd, but people who built wealth from scratch. What I discovered blew my mind. These successful individuals shared common traits. They took calculated risks, focused intensely on continuous learning, and consistently prioritized investment in personal development over traditional savings. They weren't following the conventional playbook at all. My friends and family thought I was losing it when I explained my plan to systematically question and potentially break every financial rule I'd been following. "You finally got some stability. Why risk it all on these crazy ideas?" my best friend asked. My parents were even more concerned. "We didn't put you through college so you could throw away financial security on some get-rich-quick scheme." Their concerns planted seeds of doubt. Was I being reckless? Would I end up worse than when I started? These questions kept me up at night. But deeper research only confirmed my suspicions. The traditional path wasn't designed for extraordinary results. To manage my fear and track my progress, I created what I called my rule-breaking financial dashboard. This wasn't just a simple budget spreadsheet. I built a comprehensive system to track both financial metrics and psychological shifts throughout my experiment. The dashboard consolidated data from various sources to provide real-time information on multiple income streams, expense categories, investment returns, and net worth changes. I color-coded each financial rule I was challenging and tracked specific metrics related to each experiment. For instance, when testing alternatives to the traditional savings approach, I monitored not just the raw numbers, but also the opportunity cost and potential returns of redirecting those funds. I also incorporated a risk assessment score for each experiment, ensuring I wasn't taking blind risks, but calculated ones based on research. The psychological component of the dashboard was equally important. I tracked my daily financial stress levels on a scale of 1 to 10, noted specific money fears as they arose, and documented moments of financial confidence. This allowed me to see correlations between my mindset shifts and financial outcomes. Was I making decisions from fear or opportunity? The data helped me recognize patterns, but I wasn't naive about the risks. Breaking financial rules could have serious consequences if done recklessly. That's why I created multiple safety nets before beginning this experiment. First, I established a modest emergency fund, not the 6 months of expenses financial experts recommend, but enough to cover 2 months of absolute essentials if everything went sideways. I also developed contingency plans for each rule-breaking experiment. Before launching any new approach, I asked myself, what's the worst that could happen and how will I respond? Then I created specific action plans for those worst-case scenarios. For example, when I later decided to redirect some of my savings toward income-generating experiments, I predetermined the maximum amount I was willing to lose and established clear criteria for when to pull the plug. Risk tolerance played a major role in my planning. Psychological studies show that individuals with higher risk tolerance are more likely to pursue alternative investments and entrepreneurial ventures. Understanding my own risk profile was crucial for making informed choices that wouldn't keep me up at night. I wasn't interested in blind gambles. I wanted strategic risks with defined parameters. Another crucial safety net was diversification across my experiments. I never put all my financial resources into a single alternative approach. By spreading my rule-breaking across multiple smaller experiments, I ensured that no single failure could derail my entire financial situation. This portfolio approach to experimentation proved invaluable later. The most surprising discovery throughout this process was that breaking financial rules didn't mean abandoning all conventional wisdom. Instead, it meant personalizing my approach based on my specific goals, risk tolerance, and market conditions. Some traditional rules actually made sense for my situation, while others were clearly holding me back. As I implemented my tracking system and began my first experiments, I discovered something the financial industry rarely mentions. Financial growth requires strategic rule-breaking, not blind rule following. The one-size-fits-all advice plastered across financial websites and books simply couldn't account for individual circumstances, goals, and psychological profiles. My dashboard quickly revealed patterns that conventional financial wisdom never addressed. For example, I discovered that my investment in learning new high-income skills delivered a return that far exceeded my traditional savings rate. A $500 investment in a specialized course led to a new income stream worth $1,200 monthly within just 60 days, a return no savings account could match. The psychological data proved equally valuable. I noticed that my financial stress levels actually decreased as I took more calculated risks, the opposite of what I expected. Having multiple income streams, even small ones, provided a psychological security that no single job could match. The conventional wisdom suggesting job security was safer than entrepreneurial pursuits simply didn't hold up under the data. As my experiment progressed, my dashboard filled with insights that contradicted traditional advice. The wealthy individuals I studied weren't just saving 10% of their income. They were creating multiple income streams and reinvesting aggressively in their own capabilities. They weren't avoiding risk. They were calculating it carefully and taking strategic action despite uncertainty. The first major rule I decided to break was the sacred 10% savings rule. Financial experts everywhere preach that you should save at least 10% of your income for retirement and emergencies. But what if temporarily reducing that percentage could actually accelerate your wealth building? What if redirecting some of those savings? Breaking rule number 1, from saving 10% to income multiplication. I made a decision that would make most financial advisors cringe. I cut my savings rate in half. While they were busy telling people to save more, I was betting on something completely different, investing in myself and my earning potential. Here's what happened when I broke the sacred 10% rule. The 10% savings rule is financial gospel for a reason. It creates a safety net, builds retirement funds, and promotes fiscal discipline. But I noticed something peculiar. People who followed this rule religiously often reached retirement with just enough. What about building extraordinary wealth? What about financial freedom decades before 65? So I did something radical. I slashed my savings rate from 10% to just 5% of my income. The other 5%? That became my income experimentation fund. Money specifically earmarked to launch potential income-generating projects. Friends thought I was crazy. You're supposed to save more, not less, they warned. But I wasn't being reckless. I was being strategic. With my newly freed capital, I launched 3 different income experiments simultaneously. First, I started offering specialized freelance services in my area of expertise. The startup cost? Just $120 for a professional portfolio website and some basic marketing materials. Second, I created a digital product, a comprehensive template pack that solved a common problem in my industry, costing about $450 to develop with help from a graphic designer. And third, I invested in a small micro-business venture, a niche product I could sell online with minimal inventory, which required about $600 to launch. Not everything worked out. My first digital product was a complete flop. I spent weeks creating it and sold exactly 2 copies. That's the part most financial success stories leave out, the failures. But instead of getting discouraged, I treated each failure as a paid education. The freelancing picked up momentum within 2 months, bringing in an additional $800 to $1,200 monthly for about 10 hours of work per week. The real breakthrough came when I noticed which activities were generating the highest return on investment. My freelance work was earning me between $80 to $120 per hour, significantly more than my day job. The digital product began slowly, but built consistent passive income after I refined my marketing approach. The micro-business showed promise, but required more time than I expected. Here's where the magic happened. I started reinvesting the profits. When my freelance income hit $1,000 in the 3rd month, I didn't add it to my savings or spend it. Instead, I put $800 of it toward hiring someone to help me create a more comprehensive digital product based on what I learned from my first attempt. That second digital product generated $2,300 in its first month. I applied a strict rule to my experiments. If something wasn't working after 3 months of consistent effort, I'd shut it down and redirect those resources. This meant I wasn't emotionally attached to any particular venture. I was committed to the process of experimentation itself. By month 6, I had 2 solid income streams generating an additional $1,800 monthly. I reinvested again, this time in a specialized course that taught me advanced skills in a high-demand area. This $500 investment enabled me to raise my freelance rates by 40% overnight and attract more premium clients. The most surprising aspect was how quickly these small streams compounded. Private equity and venture capital funds aim for annualized returns of 10 to 20% over 7 to 10 years, but my personal venture fund was yielding results much faster because I could directly control the outcomes and pivot quickly when needed. My income experiments followed a distinct pattern. Start small, fail fast, double down on what works. When my freelance rates hit the $100 plus per hour mark, I focused on optimizing that business over others. When digital products showed consistent sales, I created more in that category. Everything else, I either improved it radically or abandoned it. The income growth curve was striking. Month 1, $0 in additional income. Month 3, $950. Month 6, $1,800. Month 9, $2,700. Month 12, $3,500. This additional income equaled nearly the amount I would have saved under the traditional 10% rule, but with a crucial difference. It wasn't a static sum sitting in an account. It was a growing stream that would continue generating returns. What's more, many successful freelancers in my field were earning $20 to $150 per hour, depending on their skills and market demand. I found myself comfortably in that range within just months, not years, because I was willing to invest in rapid skill development rather than just incremental saving. The conventional wisdom I'd been following had fundamentally misled me. I realized that for people in their wealth-building years, saving is actually a rather inefficient path to financial freedom compared to increasing income. A dollar saved is just a dollar, plus modest interest. But a dollar invested in income growth can return multiples. Even more fascinating was watching how successful income experiments created a compounding effect. One client led to 3 more. One digital product created an audience for future products. Each micro-success built momentum for the next attempt. I wasn't just growing linearly, I was growing exponentially. As I tracked my results, I uncovered something case studies of successful entrepreneurs had shown. Those who built multiple income streams often allocated their initial capital strategically, reinvesting profits from successful ventures while quickly abandoning underperforming ones. I was seeing this play out in my own financial life. Looking at my spreadsheets, the math became undeniable. Even if I had saved the full 10% of my income as recommended, after a year I would have accumulated roughly $4,500 plus minimal interest. Instead, by redirecting half of that into income experimentation, I had created streams generating $3,500 monthly, or $42,000 annually. That's nearly a 10x return on the same capital in just 1 year. The best part, unlike savings, which require continuous contributions to grow, these income streams had momentum. Even if I stopped actively working on them, many would continue generating returns. The digital products sold while I slept. The client relationships brought in referrals without additional effort. By breaking this sacred financial rule, I hadn't been reckless, I'd been strategic. I wasn't ignoring the importance of savings, I was just prioritizing income growth first. Once my income substantially increased, I could save both the recommended percentage and continue funding new experiments. What if our financial education has the priorities backward? What if we should focus on expanding our earning capacity first, then saving and investing second? For most of us, the biggest untapped asset isn't some investment vehicle or savings strategy. It's our own potential to generate more income. The mindset shift from scarcity to abundance. Even as my income grew through these creative experiments, I started noticing something strange. Despite having more money coming in, I still felt anxious about finances. I'd stare at my growing account balance, but couldn't shake the feeling that it might all disappear tomorrow. That's when I realized I had been treating my entire financial life like a game of defense, constantly protecting against loss rather than playing to win. This defensive posture stemmed from a deeply rooted scarcity mindset that had been with me for years. I'd obsessively check my accounts multiple times daily, agonize over every purchase, even essential ones, and experience genuine physical anxiety whenever an unexpected expense appeared. Even with my new income streams, I found myself hoarding cash rather than strategically deploying it. The most telling sign? I'd consistently pass on opportunities that required any upfront investment, regardless of the potential return. My brain was hardwired to see spending money as loss rather than potential gain. This mentality created a subtle but powerful ceiling on my financial growth. After researching the psychology behind wealth creation, I discovered that most financially successful people operated from a completely different mental framework, what psychologists call an abundance mindset. This perspective wasn't about magical thinking or manifestation. It was about recognizing opportunities instead of just threats, possibilities instead of just problems. My first step was identifying the specific scarcity triggers that activated my fear-based financial decisions. I created a simple tracking system in my journal, noting every time I felt financial anxiety. Then I'd document the situation, the specific thought pattern, and the defensive action I wanted to take. The patterns were revealing. Job uncertainty, large purchases, investing opportunities, and even social situations involving money consistently triggered scarcity thinking. For each trigger, I developed a specific response plan that would interrupt the automatic fear reaction. When facing job uncertainty, instead of spiraling into worst-case scenarios, I'd review my multiple income streams and remind myself that no single source determined my financial security. For large purchases, I created a value assessment framework that evaluated long-term benefits against immediate costs, rather than just seeing money going out. I implemented cognitive behavioral techniques to challenge my negative beliefs about money. When I caught myself thinking, I can't afford this opportunity, I'd reframe it as, how can I make this opportunity work financially? This subtle shift moved me from passive victim to active problem solver. This reframing wasn't just psychological games. It produced tangible results. When a potential client approached me with a project that required specialized knowledge I didn't yet have, my old scarcity response would have been to decline due to the $700 cost of gaining that knowledge. Instead, I asked myself how I could make it work, realized I could pre-sell the service to cover the training cost, and ended up with a new skill that added $2,000 monthly to my income. Visualization exercises became another powerful tool. I'd spend 5 minutes each morning visualizing my financial goals as already achieved, experiencing the emotional satisfaction of that reality. This wasn't wishful thinking. Research shows visualization actually primes your brain to recognize opportunities aligned with your goals that you might otherwise miss. I also implemented daily gratitude practices focused specifically on my financial resources. Each morning, I'd write down 3 things I was grateful for about my current financial situation. Some days it was as simple as I'm grateful I could pay my electric bill without worry, or I'm thankful for the laptop that allows me to earn income from anywhere. Celebrating financial wins became a ritual. Instead of immediately moving the goalposts whenever I achieved a financial target, I'd take time to acknowledge the progress. These celebrations weren't necessarily expensive, sometimes just a special coffee or an hour doing something I enjoyed, but they reinforced the positive feedback loop between action and results. The most interesting part was tracking how these mindset shifts correlated with financial outcomes. I added a mindset score to my financial dashboard, rating my daily abundance thinking on a scale of 1 to 10. Over time, a clear pattern emerged. Periods of consistent abundance thinking preceded financial breakthroughs by about 4 to 6 weeks. The contrast between financial decisions made from scarcity versus abundance was stark. When operating from scarcity, I once turned down a collaboration that required $300 in upfront costs, despite the potential for thousands in revenue. The risk simply seemed too great. After shifting to abundance thinking, I evaluated a similar opportunity by focusing on potential return rather than potential loss, invested $500, and generated over $4,000 in the next month. Even my investing approach transformed. Scarcity had me keeping money in safe, low-yield accounts where I could see it daily. Abundance thinking allowed me to place appropriate amounts in growth investments with longer time horizons, significantly increasing my returns. One particularly striking example was in how I approached unexpected money. When I received a $1,200 tax refund during my scarcity phase, I immediately parked it in my emergency fund despite having adequate savings. After developing abundance thinking, when I received an unexpected $1,500 payment, I allocated $500 to a growth investment, $500 to skill development, and $500 to emergency savings, a balanced approach that produced far better results. Emotional spending patterns changed dramatically too. In the past, I'd oscillate between extreme frugality and impulsive spending driven by momentary emotional relief. Operating from abundance, I developed a sustainable approach to spending aligned with my values, eliminating the unhealthy cycle of restriction and splurging that had sabotaged my finances. The most profound change came in how I viewed money's purpose. Scarcity had me seeing money primarily as a protective barrier against disaster. Abundance thinking helped me recognize money as a tool for creating value, solving problems, and expanding possibilities, both for myself and others. This shift didn't happen overnight. I had relapses into scarcity thinking, especially during periods of stress or uncertainty. But with consistent practice, the abundance mindset became my default operating system rather than something I had to consciously maintain. The impact on my creative problem-solving abilities was perhaps the most unexpected benefit. When you're not consumed with fear of loss, your brain can devote more resources to identifying opportunities and developing innovative solutions. Financial challenges became interesting puzzles rather than overwhelming threats. Breaking rule number 2, unconventional investment strategies. Financial freedom isn't just about changing how you think about money. It's about challenging what you do with it. When I diverted 20% of my portfolio away from safe investments into alternatives my financial advisor practically begged me not to touch, the results defied everything I'd been taught about building wealth. Let's be real about the conventional investment wisdom I'd been following. Park your money in low-cost index funds. Max out your 401k. Avoid anything that sounds alternative or risky. Stay the course for 40 years. This was the script I'd followed religiously, and sure, it was safe, but it was also keeping my money growing at a pace that would have me retiring comfortably at 75. Something had to change. So I made what felt like a radical decision at the time. I carved out 20% of my investment portfolio, money that was supposed to be safely tucked away in index funds and target date retirement accounts, and redirected it toward alternative investments that traditional financial advisors would consider downright reckless. "You're making a huge mistake," my financial advisor warned when I told him my plan. He actually scheduled an emergency Zoom call just to talk me out of it. According to him, alternative investments were a fast track to financial ruin. Too volatile, too risky, and too complicated for the average investor. But my research into successful wealth builders told a different story. The most financially free people weren't putting 100% of their money into traditional options. They were diversifying across multiple asset classes, including ones that most financial experts warn against. So what did my alternative investment portfolio actually look like? I split that 20% allocation across 4 main categories. First, I put 5% into cryptocurrency, primarily Bitcoin and Ethereum. Yes, the stuff that makes traditional financial advisors break out in hives. I didn't go all in on obscure altcoins or meme tokens, just the established cryptocurrencies with actual utility and adoption. Another 5% went into peer-to-peer lending platforms. These are marketplaces where individuals can lend directly to borrowers without a bank in the middle, potentially earning higher interest rates than traditional fixed-income investments. I directed 7% towards small business equity, essentially becoming a micro-angel investor in startups and small businesses in industries I understood. This wasn't random gambling on ideas that sounded cool. I focused on businesses where I could actually add value through my own expertise and connections. The final 3% went into what I call skill investments, courses, mentorship programs, and educational experiences that would directly increase my earning potential or create new revenue streams. Now, I didn't just throw money at these alternatives and hope for the best. I created strict investment criteria for each category. For cryptocurrencies, I never invested more than I could afford to lose completely. For peer-to-peer lending, I spread my investment across dozens of loans to minimize the impact of defaults. For small business equity, I only invested in founders I'd personally vetted and industries I understood. I tracked every penny of my alternative investment experiment alongside my traditional portfolio for 18 months. And the results? They were eye-opening. My traditional investments, the index funds, retirement accounts, and safe options, returned about 7.8% over that period. Not terrible, but nothing life-changing either. Just the slow, steady growth that conventional wisdom promises. My alternative portfolio. It was a wild ride with some serious ups and downs. But when the dust settled after 18 months, it had generated a 22.4% return, nearly triple my traditional investments. But those numbers don't tell the whole story. Each alternative category performed differently, and there were definitely some heart-stopping moments along the way. Cryptocurrency was by far the most volatile. During one particularly brutal month, my crypto holdings dropped 37% in value. I woke up one morning to find that $2,000 had essentially evaporated overnight. Watching your money disappear that quickly tests your resolve in ways I can't even describe. But I had set clear rules for myself. I wouldn't panic sell, and I wouldn't check prices daily. Just as I was starting to doubt my decision, the market reversed course. By the end of the 18-month period, my crypto investments had returned 31%, the highest performing segment of my alternative portfolio. But that return came with roller coaster level emotional stress that made me glad I'd limited my exposure. The peer-to-peer lending experiment was less dramatic, but still educational. I spread my investment across 48 different loans, from small business funding to debt consolidation. The average interest rate was promising at 11.2%, but reality struck when 7 of those loans defaulted. Despite the defaults, this segment still returned 8.3%, slightly better than my traditional investments, but with higher administrative overhead. Small business equity investments were fascinatingly diverse. I invested in 4 different businesses: a local meal prep service, a niche software solution, a content creation agency, and a specialized e-commerce store. 2 underperformed dramatically, with one actually folding completely. But the software solution exploded in growth, returning 42% when they raised their next funding round at a higher valuation. This section of my portfolio returned 18.7% overall, despite 2 of the 4 investments essentially failing. The most surprising performer was my skill investments category, investing in specialized training and mentorship programs to enhance my own capabilities delivered returns that were off the charts. A $1,200 specialized certification allowed me to increase my consulting rates by 60%, generating over $14,000 in additional income over the 18-month period. That's more than a 1,000% return on investment. Remember, 2023 was a challenging year for alternative investments as a whole. According to my research, alternative investments actually underperformed compared to public markets, which was a reversal from the previous year. Yet despite this trend, I managed to generate substantial returns by being selective and strategic. I also learned that risk management was the key differentiator between gambling and strategic alternative investing. For example, when investing in peer-to-peer lending, I discovered that new loans were being originated at wider spreads compared to public market pricing, something the JP Morgan research team has noted creates opportunities for higher returns. But to capture this opportunity without excessive risk, I had to diversify across dozens of loans rather than chasing the highest interest rates. Among the alternative investments, multi-strategy hedge funds delivered among the best performance, with total returns of about 8% in 2023. This reinforced my approach of maintaining diversity, even within my alternative allocation. The biggest lesson? Success with alternative investments isn't about blindly throwing money at exotic options. It's about aligning with skilled managers and opportunities where you have some knowledge edge. When I invested in small businesses, the ones where I understood the industry and could actually add value performed significantly better than investments where I was just providing capital. There were real risks that required mitigation. Alternative investments typically come with higher fees, lower liquidity, and the potential for significant declines. I learned the importance of thorough due diligence and disciplined investment processes to protect against major losses. Exactly what financial experts caution about. What I found most valuable wasn't just the higher returns, but the education that came with managing these investments. I developed a much deeper understanding of how different asset classes respond to market conditions. When the stock market dropped, my peer-to-peer lending investments remained relatively stable. When inflation concerns rose, my cryptocurrency investments actually increased in value. This experience completely transformed how I view the role of risky investments in a balanced portfolio. The traditional financial advice to avoid alternative investments at all costs now seems not just breaking rule number 3, income diversification experiments. Alternative investments may have revolutionized my portfolio, But they were just the beginning. I soon realized there was an even more powerful financial strategy hiding in plain sight. What if your income itself could be as diversified as your investments? The conventional wisdom we've all heard is clear. Focus on one career path, climb that corporate ladder, and hope your company values your loyalty. Financial experts constantly reinforce this message. Specialize, excel in your field, and eventually, you'll be rewarded with promotions and raises. It's the path most traveled, and for good reason. It seems safe, predictable, and respectable. But after seeing the power of diversification in my investments, I couldn't help but wonder, was putting all my income eggs in one corporate basket actually the riskiest move of all? I decided to conduct a new experiment. Instead of focusing exclusively on my day job, I would systematically build multiple income streams until no single source accounted for more than 20% of my total income. This wasn't about working 24/7 or hustling until burnout. It was about strategically creating income sources that complemented each other and provided both immediate cash flow and long-term growth potential. My approach was methodical. I created 3 distinct categories of income streams to develop. Active side hustles requiring my direct time and effort, passive income projects that would eventually run with minimal involvement, and semi-passive opportunities that fell somewhere in between. The goal was to build a portfolio of income that would continue to grow even if one stream temporarily dried up. The first phase focused on active side hustles, things I could start immediately with my existing skills. I launched a freelance consulting service in my area of expertise, charging by the project rather than by the hour. This immediately brought in an additional $1,800 per month for about 10 hours of weekly work. The startup cost? Just a professional website and some targeted outreach to potential clients. Next came a skill-based service where I offered specialized technical assistance to small businesses struggling with systems I had mastered in my corporate role. This required more upfront work to establish processes and templates, but within 2 months was generating approximately $1,200 monthly for about 8 hours of work per week. The second phase focused on building semi-passive income streams, projects that required significant upfront effort, but would eventually require less maintenance. I created a comprehensive digital product that solved a specific problem for professionals in my industry. After investing about 60 hours in development and $600 in design and platform costs, this product began generating between $800 to $1,500 monthly with just a few hours of customer support and marketing each week. I also experimented with content creation, publishing specialized how-to guides on platforms that pay creators based on readership. The first few months brought in just $50 to $100, but by month 6, as my content library grew and gained traction, this stream was consistently generating $700 to $900 monthly with only a few hours of new content creation each week. The third phase introduced truly passive income streams, investments designed specifically for regular cash flow rather than just appreciation. I invested in dividend-paying stocks that yielded quarterly payments totaling about $400 monthly on a $20,000 investment. This required significant upfront capital, but virtually no ongoing time commitment. Real estate became another focus, but not through traditional property ownership. I started with a $5,000 investment in a real estate crowdfunding platform that paid quarterly distributions averaging 8 to 9% annually. This translated to about $35 to $40 monthly, small, but completely passive. The most surprising income stream emerged when I created a niche digital product that unexpectedly took off. What started as a simple template package priced at $37 began selling multiple copies daily, generating over $2,200 in the first month and continuing to average $1,800 monthly with virtually no additional work beyond occasional customer service emails. To track all these experiments, I built what I called my income diversification dashboard, a simple spreadsheet that showed the percentage each income source contributed to my total monthly revenue. The visual was striking. When I started, my day job represented 100% of my income. 6 months in, it had dropped to 72%. By the 12-month mark, it was down to 58%. And after 24 months of consistent effort, my once stable corporate salary accounted for just 40% of my total income. What surprised me most wasn't just the additional money. it was the profound psychological shift that occurred. The fear of losing my job, which had once kept me awake at night, gradually disappeared. I realized that even if my primary employer restructured my position away, I'd lose less than half my income, and I had the skills and systems in place to quickly replace even that. This newfound security changed everything about how I approached my career. In meetings, I spoke more confidently. When negotiating my salary, I no longer felt desperate to accept whatever was offered. I even took bolder creative risks on projects because the stakes didn't feel so high anymore. The psychological benefits of income diversification proved almost as valuable as the financial ones. The numbers told a compelling story. After 2 years, my total monthly income had grown from $3,750 from a single source to over $9,400 from 7 distinct streams. More importantly, my income stability had dramatically improved. When one freelance client unexpectedly paused our contract, the impact was minimal, just a 12% temporary dip in total income rather than a financial emergency. My returns on time investment varied dramatically across different streams. Traditional freelancing generated about $90 to $120 per hour of effort. Excellent immediate return, but completely tied to my time. Digital products started slower at about $15 to $20 per hour during creation, but eventually reached an astonishing $300 plus per hour when measuring ongoing sales against maintenance time. Content creation showed the most dramatic evolution. In the beginning, it generated less than minimum wage per hour, but as my library of content grew and began cross-promoting itself, the effective hourly rate exploded to over $200 per hour of effort. This particular stream showed the power of compounding returns on creative work. The diversification experiment revealed another unexpected benefit. Multiple streams created natural opportunities for cross-pollination. Freelance clients purchased my digital products. Content readers became consulting clients. Each stream strengthened the others in a virtuous cycle I hadn't anticipated. But the most surprising winner in this experiment wasn't what I expected. While freelancing generated the most immediate income and dividend investments offered the most passive income, it was content creation paired with digital products that produced the most remarkable results. After 18 months, these two streams combined were generating over $4,000 monthly with less than 10 hours of maintenance work, a return that made my corporate salary look like a poor use of my time by comparison. Not all income streams performed equally. My attempt at an e-commerce side business consumed far more time than it generated in profit. Affiliate marketing produced inconsistent results that never justified the effort required. These lessons were valuable. They helped me double down on what was working and cut loose what wasn't. The experiment transformed my relationship with work itself. My day job shifted from being my financial lifeline to just one component of a diversified income portfolio. This mental shift was liberating. I could now make career decisions based on growth, fulfillment, and interest rather than financial fear. The failures and setbacks, what didn't work? That liberating mental shift came with a price most success stories never mention. While creating multiple income streams brought newfound financial freedom, the journey was far from smooth. Behind every entrepreneurial transformation lurks the setbacks nobody posts about on social media, and mine almost sent me running back to conventional financial safety. I need to come clean about something important. This journey wasn't a straight line to success. For every experiment that worked, at least one crashed and burned spectacularly. Transparency about failure is rare in the financial independence community, but it's essential. Without seeing both sides of the coin, you get a dangerously incomplete picture of what building wealth actually requires. Let me walk you through my 3 most expensive failures, the ones that had me questioning everything about my financial rebellion. My first major setback? An e-commerce venture that drained $3,200 and 3 months of my life. I'd convinced myself that dropshipping premium pet accessories was my ticket to passive income glory. After all, Americans spend over $100 billion annually on their pets. The math seemed simple. Source products at wholesale, mark them up reasonably, and watch the profits roll in. Reality hit hard when my carefully selected products sat unsold for weeks. Customer acquisition costs skyrocketed to $32 per sale on items with only $18 profit margins. I was literally paying people to buy my products. Add in platform fees, return processing, and the countless hours spent troubleshooting website issues, and the business was hemorrhaging money. The emotional toll was worse than the financial hit. Each day brought a new wave of anxiety as I checked dismal sales figures. I'd wake up at 3 a.m. panicking about inventory decisions. The confidence I'd built through my successful income experiments evaporated, replaced by nagging self-doubt. My second failure was even more devastating, a rental property investment gone horribly wrong. I'd put $7,500 down on a small rental unit that seemed perfect on paper. Good neighborhood, solid rental history, and a property manager who promised hands-off income. 3 months in, the tenants stopped paying rent. The property manager failed to properly screen them, and eviction proceedings dragged on for months. Meanwhile, a previously undisclosed plumbing issue flooded the basement, requiring $4,300 in emergency repairs. By the time I finally sold the property at a loss, I'd sunk over $11,000 into what was supposed to be a reliable income stream. The rental nightmare shook my faith in diversification itself. If this was what happened when you stepped outside traditional investments, maybe the conventional advisors were right all along. For weeks, I seriously considered abandoning my entire financial rebellion. My third major setback came from a digital course launch that completely flopped. After my earlier success with small digital products, I invested $2,800 in 6 weeks creating a comprehensive online course. Market research suggested strong demand, and my smaller products had built a modest audience. Launch day arrived with great expectations and delivered exactly 7 sales. Total revenue, $693. After platform fees, I was looking at a $2,100 plus loss and the crushing realization that I'd completely misread my market. Even worse, the failure was public. My small but growing audience had watched me promote a product they clearly didn't want. These failures created serious psychological challenges. I battled persistent self-doubt, questioning whether I had any business trying to build wealth outside conventional paths. Financial anxiety returned with a vengeance. I'd check my accounts obsessively, cataloging every loss. Most dangerously, I felt the powerful pull to retreat to financial safety and abandon the experimentation that had actually been working overall. The research shows I wasn't alone in this struggle. Psychological studies indicate that emotional resilience plays a key role in overcoming financial setbacks. Those who can manage their emotions and maintain a positive outlook are significantly more likely to recover from losses and pursue new opportunities. What saved me wasn't blind optimism, but a structured approach to handling failure. I developed what I call failure postmortems, detailed analyses of what went wrong and why. For the e-commerce disaster, I tracked every expense, marketing effort, and customer interaction to identify the fatal flaws in my business model. The data revealed I'd entered an oversaturated market with razor-thin margins and no competitive advantage. With the rental property, I documented the screening failures, repair issues, and legal hurdles that transformed a promising investment into a money pit. This analysis led me to discover that my temperament and skill set simply weren't matched to direct property ownership. The course failure provided valuable insights into audience needs and pricing psychology. By surveying potential customers who didn't purchase, I learned my offering was too broad, failing to solve a specific, urgent problem. These postmortems weren't just therapeutic. They became the foundation for better decisions going forward. The e-commerce failure taught me to validate market demand before significant investment. The rental property disaster led me to explore real estate crowdfunding platforms instead, where I could benefit from property appreciation without management headaches. Perhaps most importantly, I created a failure budget, setting aside 10% of my investment funds specifically for experiments that might not work out. This psychological trick transformed how I viewed setbacks. A loss within my failure budget wasn't a catastrophe. It was an expected part of the learning process. I also built emotional resilience tools into my financial practice. I established a support system of fellow entrepreneurs who could relate to the roller coaster of building multiple income streams. We'd meet monthly to share both victories and defeats, normalizing failure as part of the journey. Another technique that proved invaluable was outcome detachment, a practice of focusing entirely on process quality rather than results. Instead of obsessing over whether a particular venture succeeded, I'd evaluate whether I followed best practices, made data-driven decisions, and executed competently. This shifted my self-worth away from financial outcomes and towards skill development. Case studies of successful entrepreneurs reveal this pattern repeatedly. One well-known tech entrepreneur lost over $100,000 in a failed startup, but later created a billion-dollar company by applying lessons from that failure. The difference between permanent failure and temporary setback often comes down to how you process the experience. What ultimately made the difference was reframing these failures as expensive education rather than personal defeats. The e-commerce disaster cost me $3,200, but a comparable business course would have cost nearly as much without the practical experience. My rental property nightmare was essentially an $11,000 masterclass in real estate investing pitfalls. The failed course launch taught me more about product development than any consultant could have. This perspective shift wasn't immediate or easy, but it fundamentally changed my relationship with failure. Rather than seeing setbacks as evidence I should retreat to conventional financial safety, I recognized them as the inevitable price of financial innovation. No one builds substantial wealth without some wrong turns along the way. The resilience techniques I developed through these failures proved more valuable than any single successful experiment. Learning to analyze setbacks objectively, budget for failure, maintain emotional equilibrium through support systems, and detach self-worth from financial outcomes. These skills created a psychological foundation for sustainable wealth building. Financial literacy programs increasingly emphasize this approach, teaching young adults that understanding risk and developing resilience after setbacks are crucial components of financial success. The ability to bounce back from failure may be the single most important skill in building unconventional wealth. The transformation, before and after by the numbers. Beyond resilience and rule-breaking lies the question you're probably most curious about. What does financial transformation actually look like when measured in dollars and cents? The spreadsheets don't lie, and they tell a story more compelling than any motivational speech ever could. Let me pull back the curtain and show you the real numbers behind my financial rebellion. Because while mindset shifts are essential, you deserve to see the concrete results that followed all those unconventional decisions. When I first started tracking my financial transformation, I needed a way to visualize what was happening, not just for accountability, but to actually see patterns emerging that would otherwise remain hidden. As my research indicated, effective data visualization reveals trends and correlations that might go completely unnoticed in raw numbers. I created a financial dashboard using tools similar to Tableau and Power BI that tracked every aspect of my financial life: income sources, expense categories, debt reduction, and most importantly, the psychological metrics that traditional financial tracking ignores. This approach allowed me to spot red flags early and make data-driven decisions instead of emotional ones. Let's start with the headline number, income. My transformation took me from a single income source to what financial experts call income diversification. The dashboard clearly displayed how my income composition shifted dramatically. What began as 100% reliance on a single paycheck evolved into a robust ecosystem of revenue streams. The visualization showed a steady climb, with multiple income streams creating a combined annual revenue exceeding $120,000, a 166% increase from where I started. The line chart tracking this growth wasn't linear. It showed distinct acceleration points that corresponded directly with specific rule-breaking experiments. Each new income stream appeared as a new color band on my stacked bar chart, visually demonstrating how my financial foundation strengthened as I reduced dependency on any single source. But income was just one piece of the puzzle. The investment section of my dashboard revealed an equally dramatic shift. Interactive visualizations compared the performance of my traditional and alternative investment approaches side by side. What began as a conservative portfolio yielding modest returns transformed into a dynamic investment strategy, producing substantially higher results. My bar charts comparing returns before and after implementing unconventional investment strategies showed the stark contrast. The blended return across all investments rose significantly, with allocation pie charts highlighting how the proportion of alternative investments grew as their performance validated the approach. Perhaps the most satisfying visualization was the debt elimination chart. The downward slope of my debt line created an almost physical sense of relief as it approached zero. What made this chart particularly powerful was overlaying it with the psychological metrics I was tracking, showing how financial anxiety decreased in almost perfect correlation with debt reduction. The debt journey wasn't just about elimination, though. My dashboard differentiated between bad debt, high-interest consumer debt, and strategic leverage. As the high-interest debt disappeared, I began using leverage differently, as a tool for wealth creation rather than consumption. One of the most revealing aspects of my visualization system was the ability to create what I call decision point markers on all my financial charts. These highlighted moments when I deliberately broke a financial rule, allowing me to see the direct impact of each decision. The pattern became unmistakable. Periods of pronounced growth almost always followed these rule-breaking moments. But what about expenses? This is where my visualization system revealed something unexpected. While conventional wisdom suggests cutting expenses is the path to financial improvement, my expense line remained relatively stable throughout the transformation. The key difference was the nature of those expenses, shifting from consumption to investment in income-generating assets and skills. My net worth chart told the most comprehensive story. The line remained essentially flat for years while following conventional wisdom, then showed a dramatic upward trajectory once the rule-breaking began. The visualization made it impossible to ignore the correlation between unconventional financial decisions and wealth accumulation. What truly sets my tracking system apart, though, is the integration of psychological metrics alongside financial ones. Using tools from financial psychology research, I created numerical scales to measure factors typically considered soft or unmeasurable. For example, I tracked financial anxiety scores using a simple 1 to 10 scale, logging my rating each week. The resulting line chart showed my anxiety score dropping from an average of 8.2 to just 2.3 over the transformation period. I could literally see how my relationship with money was healing. Another psychological metric I tracked was what researchers call financial self-efficacy. Essentially, your confidence in handling money matters. This score rose from 4.1 to 9.3, creating an almost mirror image to the anxiety chart. The visualization showed something profound. My psychological wealth was improving at a pace that matched or even preceded financial improvements. Quality of life indicators provided even more insights. Using metrics similar to those in formal financial well-being studies, I tracked factors like sleep quality, relationship satisfaction, and creative fulfillment. The dashboard revealed correlations between financial improvements and quality of life enhancements that conventional financial tracking would miss entirely. One particularly revealing metric was my financial flexibility score, which measured how quickly I could adapt to unexpected financial opportunities or challenges. This score more than doubled, reflecting a fundamental shift in my financial resilience that raw dollar figures couldn't capture. The visualization system also helped me identify which rule-breaking experiments produced the highest return on investment, not just financially, but in terms of life satisfaction. Some high-income activities scored poorly on life satisfaction, while others with moderate income created disproportionate happiness. This insight guided my decisions about which income streams to expand or contract. What's remarkable is how these visualizations revealed lag periods between mindset shifts and financial results. My abundance mindset scores would improve weeks before corresponding financial improvements appeared, suggesting that psychological shifts may actually precede financial transformation rather than result from it. The complete before and after picture told a story that spreadsheets alone never could. My financial liberation wasn't just about increasing income or eliminating debt. It was about creating a fundamentally different relationship with money, one where money served my goals rather than limiting them. Before my transformation, the numbers reflected a financial prison. Afterward, they showed financial freedom. Not just in dollars and cents, but in reduced stress, increased confidence, and a profound sense of control over my financial future. The best part, these aren't just abstract concepts or motivational talking points. The visualization system made these changes concrete and measurable. I could literally see the impact of breaking financial rules in colorful charts and graphs that validated what might otherwise seem like risky or counterintuitive decisions. My dashboard became a powerful accountability tool, helping me maintain momentum when the inevitable setbacks occurred. By visualizing long-term trends rather than short-term fluctuations, I could your turn, identifying which rules to break. Visualizing your financial dashboard might have you wondering, which financial rules should you personally break to achieve similar results? Let's face it, not every rule needs shattering. The trick is figuring out which ones are specifically holding you back from your unique version of financial freedom. While tracking my progress was essential, knowing exactly which money rules to challenge made all the difference. The 100 minus your age investment rule? That outdated guideline could be costing younger investors thousands in potential returns over their lifetime. What works for someone nearing retirement could be seriously blurring your financial vision if you're decades away from that milestone. I've developed what I call the Financial Rule Assessment Framework, a systematic approach to evaluate which conventional wisdom you should keep, modify, or completely abandon. This isn't about random rebellion. It's about strategic rule-breaking tailored to your specific situation. Start by examining each financial rule through 3 critical lenses: relevance, restriction, and results. For relevance, ask yourself, was this rule created for someone in my exact financial situation? Many financial guidelines were developed decades ago for people with pension plans and stable 30-year careers, a reality that simply doesn't exist for most of us today. For restriction, consider, is this rule limiting my financial creativity or preventing exploration of newer opportunities? Take the traditional advice about avoiding risky investments. This might be protecting you, or it might be keeping you from appropriate growth investments that match your actual risk tolerance and time horizon. Finally, for results, ask the most important question. Has following this rule actually improved my financial situation over the past year? If not, it might be time to experiment with alternatives. Let me share how this works with a specific example. The 100 minus your age rule for asset allocation suggests that a 30-year-old should have 70% of their portfolio in stocks and 30% in bonds. But financial advisors increasingly recognize this as outdated. This rule was created when life expectancies were shorter and retirement periods briefer. For many younger investors with longer time horizons and higher risk tolerance, breaking this rule could mean embracing more aggressive investment strategies that potentially yield significantly higher returns. The key is personalization. Your assessment should consider your unique risk tolerance, financial goals, and current economic conditions. Generic rules simply can't account for your specific circumstances. Based on your assessment, sort each financial rule into 3 categories. First, rules to keep. These are principles that align with your financial psychology and consistently generate positive results for you. For many, the rule of spending less than you earn belongs here, as it's foundational regardless of your financial strategy. Second, rules to modify. These guidelines have some merit but need customization. Perhaps the emergency fund advice is valuable, but instead of the standard 3 to 6 months of expenses, your freelance career with irregular income might require 9 months of coverage. Third, rules to abandon. These are outdated concepts actively limiting your growth. The belief that real estate is always the best investment might fall here if your local market is overvalued or if you need greater liquidity for your personal goals. Once you've categorized these rules, it's time to create your financial experimentation plan. Start small with low-risk rule-breaking. This isn't about throwing caution to the wind. It's about calculated experiments with manageable risk. For example, if you've identified that the focus only on your career rule is limiting your income potential, you might allocate just 5 hours weekly to launching a side project. This allows you to test the waters without disrupting your financial stability. As you gain confidence and see results, gradually expand your experiments. Financial literacy programs like FIS Financial Literacy Education offer comprehensive resources for young adults looking to develop this kind of critical thinking. Their interactive lessons help participants evaluate their current financial knowledge and develop practical skills for making personalized financial decisions. Similarly, Operation Hope provides customized financial education programs focused on economic empowerment, offering their services at no cost to make them accessible to broader audiences. When designing your experiments, experts recommend starting small and gradually expanding as you gain confidence. This approach allows for manageable risk while exploring new financial strategies. Remember that diversification of income streams is vital for financial resilience, something I discovered firsthand through my own experiments. Just as important as tracking financial metrics is monitoring psychological responses. Create a simple spreadsheet that tracks both your financial outcomes, income growth, savings rate, investment returns, and psychological metrics, financial anxiety levels, confidence scores, sleep quality. This dual tracking reveals patterns you might otherwise miss, like how reduced financial anxiety often precedes better financial decision-making. Consider tracking spending habits, savings rates, and your emotional responses to financial stressors. This comprehensive approach to measurement provides deeper insights than numbers alone. I found that my best financial decisions often came during periods when my financial anxiety was at its lowest, allowing for clearer thinking and more strategic risk-taking. Financial advisors increasingly emphasize that financial literacy shouldn't just focus on traditional education, but should incorporate behavioral finance principles. Understanding the psychological barriers affecting your financial decisions is often more important than knowing which investment vehicle offers slightly better returns. When you recognize how your emotions influence your financial choices, you can develop strategies to overcome these limitations. The real power in breaking financial rules comes from adaptation. Market conditions change, personal circumstances evolve, and financial strategies must adjust accordingly. The rigidity of conventional wisdom often fails to account for these shifts. By developing your own flexible framework, you become resilient to economic uncertainty rather than vulnerable to it. Remember that financial experiments should be treated as learning opportunities regardless of outcome. Document what works and what doesn't. Each experiment, whether successful or not, provides valuable data about your personal financial psychology and the strategies that align with your specific situation. So here's the truth about breaking financial rules in 2025 and beyond. It's not about rebellion for its own sake. It's about finding what actually works for you. Looking back at my journey, the biggest lesson wasn't that traditional advice is wrong, it's that it's incomplete. In the real world, success doesn't come from blindly following one-size-fits-all rules. It comes from thoughtfully experimenting with approaches tailored to your unique situation and psychology. The data supports this personalized approach. Financial experts increasingly recognize that while traditional rules provide useful guardrails, your best results will come from adapting them to your individual circumstances. Young adults particularly benefit from practices like the No Spend Week challenge and the 48-hour rule for purchases, small experiments that reveal which conventional wisdom might be limiting your potential. Your financial transformation begins with a single question. What if there's a better way? Start small, track your results, and trust your experience. The path to financial freedom isn't following someone else's map.